This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Today on the show, I have Mike Dever. And for those that have been following my show will realize that Mike was is my first interview on the show back many months ago. And I thought it'd be great to have Mike back because Mike has got a world of experience. And I think what's also interesting about Mike is not only has he been on the fund management side, the systematic trading, the trend following side, also an entrepreneur, also an author. His book, which I highly recommend, with the title that you can't forget, Jackass Investing, Don't Do It, Profit From It. And there's actually a really cool dude on the back who gave it a nice blurb that happens to have a name very similar to mine. I'm not so sure if it's actually me, though. But anyways, Mike, thanks for joining me again today. And I think we'll have plenty of stuff to talk about.
Thanks, Michael. Appreciate it, and happy to be back.
So let me get into it a little bit before we talk about some of the trading stuff. You have definitely had an entrepreneurial career. So I want to know, what was Mike Dever like at 12 years old? Because how did you unfold to be this entrepreneur?
Well, yeah, it's a pretty good question. I started out at 12 years old. I was doing paper route and other small business thing, but I'd started a company called STAR, which is Scientific Team of Aviation Research, been selling rocket plans. Was involved in a number of different entrepreneurial activities even at that age. But one of the things that you look back on is spreading out the Wall Street Journal on my room floor and looking at the stock price numbers and just being fascinated by it, trying to figure out what they meant and if there was something else that I could learn from that.
Well, listen, so I want the audience to know we just kind of we did a little switch there. We went from Skype to the landline. The internet was not cooperating, and I want everybody to hear exactly what Mike is saying. So, Mike, let me just let you reiterate there. You were talking about a fairly intricate sounding process that you got involved in at a very young age. Can you restate that?
Sure. I guess I was always entrepreneurial. I never really thought of it as anything but being interested in business and science and mathematics, and so I was always involved in projects. And one of those, at an early age, I was into model rocketry, and so my brother and I started a company called STAR, which is Scientific Team of Aviation Research, and we made rocket plans and sold rocket plans in the back of comic books. Made a lot of rockets ourselves. I was running the paper route, but that kind of all just led into the trading side was when I started looking at stock tables in the Wall Street Journal and started trying to figure out what those were all about. And I had a fascination with that. That stayed with me until I finally got involved in that about 10 years later.
Well, let me keep it while you're young for a second.
Yeah.
So you're in the process. This is the quintessential entrepreneurial story. We've all done. Anyone that's made an entrepreneurial dollar has started in some way that most people don't expect, because most people think it's always gloriously exciting at the beginning, but it's usually just a lot of hard work and kind of a creative idea, which is what you're describing. So as you're doing the model rocket business, okay, what about age did the markets trigger with you of like, oh, this is going on and I might be able to make money from this? What age did that first happen at?
That really wasn't until later, early 20s.
Early 20s.
And it was early 20s. It was 1979. I had sold a car, and I made some money from that, and I was looking to make an investment. And the gold market was really heated up at that point, and I bought some gold options. So it took a while, because in between there, I had a construction business. I was doing home remodeling and also some new home construction. So I did a bunch of different things in between before I got involved in the actual trading.
Now, your actual trading, if I'm not mistaken, we're talking starting in 1979, and I'm going to put the number out there because 5K, right?
That's correct. That's the number, right?
So, I mean, I know, look, 5K is not a huge amount of money. And I think sometimes people get caught up in the idea that you have to have this perfect number, but you started with a very small amount. It doesn't mean you couldn't have blown out, but I'm sure you were very tight on your risk and very concerned. But talk about it for example, the folks. Have you ever seen people that start with huge amounts of money and don't make it?
Oh, absolutely. I mean, it doesn't matter. I mean, it does matter if you start too small. It does make it more difficult. You can't create a properly diversified portfolio. That is more difficult. If you have $1 million, you've got a lot more opportunity to create a properly diversified portfolio and sustain your trading over a long period of time than if you start with 5,000. But the problem is if you're not doing the right things, it doesn't matter how much you start with. You could be J.P. Morgan and you could lose billions, right? So it all gets down to the style of trading, the methodology you employ, the diversification, the control of risk. It really gets down to that. It's just much harder to employ diversification, to control risk with smaller amounts of money.
But I guess from your perspective, if you're talking to people, and I know your book goes into this as well too, not everyone starts with this huge amount. So and I've done so many interviews with folks that start with small amounts. And I think, is there something from your perspective about starting small psychologically? And if you do it right, that is building something in you that perhaps is different than if you're just, if dad happened to be worth 20 million and dad gives you a chunk of change and you don't really have an appreciation for it. Can you speak to that a little bit?
Oh yeah, no question. I mean, the one comment made in that was do it right, and I've seen guys that have started with rich families, started investing the money, and just immediately went into decline and just continue to lose year after year. They never developed the discipline to trade properly and to manage the risk, where you are forced to do that with a small amount of money. You have no option, or you'll be out of money very quickly. It doesn't mean it's easier. It just means that the people that start and survive that smaller money phase have probably either innately or through learning developed really good risk management skills, and they've been able to control that downside in their portfolio. In Jackass Investing, in the action section, we lay out specific portfolios people can employ. But even in those, if you want to have the full broad portfolio, you still need about $60,000. You can make a subset of that, create a subset portfolio with maybe 10 or 20,000, and it would probably be okay, but it wouldn't provide the full diversification that you can get with a 60. And then we have a even broader diversified portfolio that requires closer to half to $1 million. But people don't need that. With 10 to 50, you can create a reasonably diversified portfolio.
We're going to jump into a lot of the Jackass Investing stuff because it's just great stuff, and I think people can learn a lot. But I want to ask you about your early career in your early 80s, and if you're setting up a CTA early, a commodity trading advisor, regulatory term, but you had some really interesting experiences at a fairly young age with some of what became the bigger names on Wall Street. And two in particular, and I wonder if you could maybe pass along either an insight or a lesson or an experience, something that happened with your involvement, and maybe to explain to people exactly what your involvement was with two legendary names. And those two names would be Paul Tudor Jones and John W. Henry. Why don't I let you run with both of those for a second?
Sure. Okay. I'll lead into that. When I started out, so let me kind of back up to 79 again. I was trading. I had my $5,000 portfolio. I did run that up pretty rapidly to about $60,000, thinking I really discovered the Holy Grail here. I knew exactly what to do. And over the course of the week, watched in $10,000 chunks most of that money disappear. And that led me, it was in 1980s, early 1980 now, mid-1980. I decided, what I need to do? I need to set up a fund. I need to put a more structure to it, develop some systematic trading models. And so I went up to Westchester University where I graduated and got on their mainframe computer, and I would do this from generally about 10 o'clock at night till 8 o'clock the next morning because I would be the only one sitting in the room accessing the terminal. And I developed some trading models And I put together a fund that I launched in 1981 with $26,500. And that was $2,000 chunks, generally from like my Boy Scout leader, my grandmother. I couldn't get money from my grandfather because he didn't want to be involved in futures. They were too risky. And I started trading that. And I traded that for about 2 years with reasonably good results, but volatility in it. And what I came to the conclusion in like 83 was I wanted to put together a fund that would use an outside manager in addition to one that I was trading to diversify my business a little bit. And one of the first things I did, and this is probably now into 82, 83, leading into that, is I got on the phone to Shearson and I talked with Dick Donchian. Dick Donchian was the grandfather, and that was the word everybody used even then, of trend following trading. He had developed a breakout model in the 1960s, started trading that, and by the 1980s, when I was getting involved in this, he was in his 70s, acknowledged as the grandfather of futures trading, managed futures. And so I called him, we had a discussion, and he got all excited about putting a fund together with me. I would raise money, he would trade it. I went up and met with him and Paul Dean, who was his assistant in Connecticut, laid everything out, started putting the fund together, got all the documents written, and I got shot down by the Shearson legal team. Said, you can't do this. We're not going to allow a fund using one of our managers, or a broker, essentially, to be sold under somebody else's name. And it was really discouraging, disheartening at the time. I thought I was, on to getting this thing going. It would have been great. Dick was excited about it as well, and we had to fold the project.
But this was just a fund of funds, though, right?
It was going to be a single manager fund. He was going to be the manager, and I was raising the money for that.
But this isn't abnormal today, right?
No, exactly. No, very normal. Very normal process.
You're just saying basically you're a little bit ahead of the curve, maybe?
Absolutely.
Okay.
That's exactly what it was. They didn't understand it then. Then they were brokers. These guys, CTA was a pretty new term still. NFA was just founded. And so to go to a broker and ask him to manage your money in a fund was a pretty novel concept at that time. Brokers had their own clients, and they managed money for those clients in individually managed accounts. You didn't get a third party put a fund together for that broker to manage that money. It was unusual. So I still had the idea I wanted to do this. So I went out and I looked at different traders out there, other CTAs, and I found 3 of them that I thought would be suitable for managing this fund I wanted to raise money for. And one of them was Wallace Jenkins, and of course Wallace has gone on to some great success in the last decade. He had the second one was a guy by the name of Nathan Cantor, and the third was Paul Tudor Jones. And after meeting with them and going through their data, I decided to launch the fund in 1983, late 83 or 84 with Nathan Cantor. And the reason for that was Nate only risked the interest income he earned on his account every month. So I could start out with a conservative fund, go to investors and say, hey, look how safe it is. You can put money into this, and he's only going to risk the interest income each month. So if you have a losing month, it's just from his management fee he takes. And I talk about this in the introduction in my book. I had investor after investor I talked with who said, oh, it's a commodity fund. That's too risky. I can't invest in that. I'd explain what I was doing, how Nate traded, and they'd say, it doesn't matter. That's commodities. They're too risky. And I started realizing that there was people just had this perception, whether it was right or wrong, didn't matter how you structured it. If you're trading in commodity futures, it had to be risky. Now, I did raise some money, $311,000, so $311,625, and I started trading that with Nate, him being the manager on it. And we traded it for about 6 months, and the performance was flat. And I started getting redemptions. People saying, I got into this thinking this was going to be a high rolling fund. It's not made any money yet. I mean, it didn't lose anything, but it wasn't making anything. I want to redeem my money. And I started getting redemptions, so it was down to about a little over $250,000. And I got back in my car, drove to New York, met with Paul Jones again, and I said, okay, I've got $250. Can you manage that? Are you ready to take it? And he said, oh yeah, sure. So at the time, Paul had, it was in the millions. It wasn't even tens of millions under management, and we allocated him the 250.
So he was small at the time. Very small.
Very small.
Yeah.
Yes, a small trader. And his track record, the reason I didn't allocate him out of the gate, and the reason I went to Nate, was because I was looking for something that was safer, a little more conservative. And Paul's track record, when you looked at it, 1983, 1982, the returns were 20%, 15%. 5%, 32%. Those were monthly returns. That wasn't his annual returns. They were his monthly returns. So it tended to scare me a little bit. I thought this was just a little bit too aggressive for what I was trying to accomplish with this first fund. Where I was really looking for something to provide a steady income, diversify my business. So I went back up. We opened the account with Paul, and to use the classic sort of cliche, the rest is history. For the next 3, 4, 5 years, Paul was doing triple-digit returns for our account. And part of the reason was he had great numbers. But I also, when I set the account up with him, I double leveraged on top of what he'd already done. I kind of learned my lesson, I guess, from my investors that, hey, it's a commodity fund. I want some action in this thing. So we not only went with the more aggressive trader, but we leveraged that trader up by, not so much notional funding. He just traded it more aggressively for us. And we had great numbers over that period of time. So that was Brandywine Partners. I ran that for the next probably 7 and 8 years with Paul before he started focusing on only managing his own funds and offshore products, and he stopped trading all the domestic funds.
Gotcha. Now I think you also mentioned that you had some early involvement experience working with John W. Henry.
Correct. So John and I met in 1982, one of the early conferences, the Managed Account Reports conferences. We were in Chicago, and we were two of the newcomers to the industry. He had $382,000 that he was managing at the time. It was his own money. He had been running a farm. He had also, as he described me at the time, wrote a book on card counting. Made something on the order of $800,000 in 2 weeks selling this book, almost more like a pamphlet. And he started trading, and he had really good success over the first 12 months. So this was probably 1981 into when I met him, 1982. I made some introductions for him at the time, so I'd talked to just about everybody in the industry at that point. That's when I got involved in the business. I just picked up the phone and talked with Bill Dunn and the Campbell brothers and anybody that was out there doing anything to try to understand the business. And made some introductions, and I got a bottle of champagne for John getting his first few $1 million account, which I wish I had the fees on it now, but the champagne was nice at the time. And then a couple years after that, opened an account with John. So I set up another fund. So I had the one with Paul Jones, and a couple years after that, set up a fund to have John Henry manage it. So I had a couple different funds using outside managers in addition to my own trading. So yeah, John and I were around in the business at the early days there, and stayed around in touch for a number of years after that with me allocating money for him to manage for us.
Let me ask you, Mike, because I know we're part of this conversation is we're getting the audience to see all these different experiences and insights that you can give. But I think since you had this really incredibly early insight with some of these very well-known guys, and look, everybody puts their pants on the same way, but sometimes success can make people kind of might not see as clearly. So you have this great early insight into, let's talk about John Henry for a second. So what, from your perspective, were some of the traits that you were seeing, and these might have been the exact same traits that you were using for yourself, but what were some of the traits that you were seeing in him as a young man that another young man out there today could learn from, kind of that you could pass along? What are some of those early things that you saw?
Well, a couple things. John had developed a trading system. He didn't have a big research process necessarily. Didn't have a lot of PhDs. He had come up with an idea. He tested his idea, and it worked. And so it was a pretty simple, trend following kind of system. But he had the utmost confidence that it was the right thing. Maybe he didn't see beyond that, and a lot of other things he could have done at the time, but it didn't matter because he found one thing that did work, and he had total confidence in that. So when he started trading, he didn't deviate. You didn't see John sitting there questioning the signals coming out of his system. He just followed that. So he had the confidence and he had the discipline to be consistent and follow that system on a consistent basis. And when it started working, started bringing money in, he continued to do that, which appealed to the investors who didn't want somebody changing things around all the time. The other thing to remember, at this time, discretionary traders were really the hot thing. Nobody wanted somebody that had a system. They were kind of the outcasts. It was, black box, it was the way people would view it. And I don't know how many times I would talk to investors and they'd say, well, I want somebody who's sitting there analyzing the markets every day, because they're constantly changing. I don't want somebody who did something 2 years before and is not changed and is following that. It's a total different mentality than you start to see today when people are looking at systems and believe in systems. At that time, that was unique, but John had the confidence to stick with it, to believe in the system, and to follow it. Now, the second thing is John started seeing some performance degradation. He had some volatility in the mid-'80s in his original model, and he made some changes, introduced new portfolios. And when he introduced his financial metals portfolio, that's what really launched his business. If you look in the early 90s at the performance of John Henry's original program versus financial metals, you could see that if he'd stuck with the original, he probably wouldn't have ever grown his business, maybe not maintained it even. But he created another product that investors really jumped on, had great performance over the next half decade, and that's where he attracted hundreds and hundreds of millions of dollars. The other thing that he learned, and not so much him probably, but Ken Tropin, because Ken was running Dean Witter's managed funds business, Ken put together 3 different products that John Henry and some others were managing. They had a conservative, a medium volatility, and an aggressive product. And almost out of the gate, all the money flowed into the aggressive product. And so John maintained, he was a big chunk of that aggressive product, and he maintained that aggressive stance even as he rolled out new funds and new products. So he kind of hit the sweet spot of the marketing and the sweet spot of the industry at that time. He had good, strong performance. It was high numbers, even though it was volatile. That's what people were buying into at the time because that was their perception of what managed futures should be.
Isn't it interesting that this period in the 80s, early 90s perhaps, where volatile returns, larger returns were desired, chased, allocated towards, how much the world has shifted to where it has become almost a nervous Nelly situation where you have all these great traders that know how the world works, know how markets work, and they've got their hands tied behind their back because they won't get the allocations from the pension funds and the endowments that usually don't know their blank. I guess I can use Jackass. They don't know their Jackass Mahole in the ground because I'm looking at the title of your book. I figure I could say Jackass. They don't know their they don't know their Jackass Mahole in the ground. But all these great traders have to sit there with one arm tied behind their back and listen to these folks go, "Oh, we don't want single digit returns, no volatility, no standard deviation." It's amazing the shift that's happened.
Absolutely. People are, they're afraid of their own shadow here. When we relaunched last year, we launched Brandywine Asset Management's trading again. We really set up the same product, but 2 different leverage levels for it. We have our standard Brandywine Symphony program targeting 12% return, 8% standard deviation. That's based on where people want to be today in general. An institutional investor, certainly, they want to allocate to something like that. And then we just simply have a more notionally funded, higher leverage product that's somewhere between 3 and 5 times that, depending on performance and where we are. And we have a model that allocates it that way. That's where my money goes. And, that seems to be where most individuals put their money, but we still have that institutional product, that is appealing in that return and mostly in that risk volatility area that is more appealing to an institution.
Mike, I'm going to jump into, I want to talk about something from Jackass Investing here in a second, the issue of return drivers, but I wanted to follow up on this point real quick. When I look at Southeast Asia, I look at Hong Kong, I look at Singapore, I look at Macau, And having been over there, I see this enthusiasm, this desire where people are no longer this desire to get rich. They still want to make money. Can you, given your experience and your look at this industry and investing in the markets over the last 3 decades, is there a pivot point where folks in America kind of just dialed it back? Is there a moment in your head where it changed?
Well, it started happening when a lot of the convertible arbs and some of the other hedge funds in the 90s became more and more popular. And I started hearing things from investors who would say, well, you're too volatile. You might have a product that has 15% volatility, which is stock market, or less. And they'd say, no, we can't invest with that. That's too volatile. So, well, what is it you're looking for? Well, I've got this investment. This guy is doing pretty much a steady 1% a month, about a 4% annualized standard deviation. And they started all gravitating to these same mean reversion type strategies because they had the perceived lower risk as measured by the volatility they were experiencing every month. And so they got more and more used to that. And then when a lot of those things blew up in 2008...
The long-term capital managements, for example?
Well, or in 98 with long-term capital. Yeah. But then in 2008, the financial crisis, a lot of the really safe stuff, they got crushed. A lot of these guys retrenched even more. Now they felt they couldn't trust anything. They don't recognize the difference of volatility being really representative of risk and when it's not. Managed futures, generally what you see is what you get. The risk is there, it's exposed, it's out on the sleeve. Whereas a lot of these other strategies, the risk was hidden, and there was event risk that only popped up under certain conditions. And they don't know to differentiate between those. So what I saw was a lot of the last decade, leading into 2008, where people were gravitating to those less and less risky in their minds, we all kind of knew better, trading strategies and allocating more and more to those. Unfortunately, what I feel like has happened over the last 5 years is that in the United States, aside from some pockets of risk-taking and innovation, like a Silicon Valley, most of the country and most investors are afraid to take risk. And losing, whether it's a new business and, coming from an entrepreneurial standpoint, is starting to be viewed negatively, where it was almost a badge of honor, for my first 20, 30 years in the business here, the first 20 years, I guess, that if you lost and you made it through that battle hardened you've learned something. And I would have so many investors even early on that would say, okay, tell me your worst loss and what you learned from it. And they wouldn't invest with somebody that hadn't taken a big hit at some point. Whereas now, if you have that loss in your record in any kind of way, it's repulsive to investors. You're really kind of vilified for that. I don't see that as much in Asia. I think they have a lot of opportunity to overtake the U.S. in a lot of areas because of our risk aversion that we've grown to here.
No, I think and this is why I wanted to address the word entrepreneur with you early on, is I think there is psychologically for those folks that say, I want to avoid risk. I don't want any risk. That very act in itself is taking a risk.
Right. I was on last month on Tim Fox's show on Bloomberg, and he asked me early in the show, early in my interview, what do you think of this? The 10-year bonds has dropped under 1.5%, and I'm not sitting there giving predictions. It's not my business. We follow models in our trading, but I could make a comment that's the risk. I said that's the riskiest trade out there because if you're a pension fund and you need 7% a year, and you put it into something that's giving you 1.5 guaranteed. You're guaranteed a loss. The problem is people aren't viewing risk by what they need to achieve return-wise. They're viewing it by whether they're going to have a loss of below zero. And that's the improper way of looking at it. You've got to look at it as, if I need 7%, how do I make 7%? Putting it at 10-year is the riskiest trade you can make. Putting in something that has the chance of making 7%, but may have a 20% variance around that on any given year, okay, that's less risky. I don't care what the volatility looks like. It's less risky because you have a higher probability of achieving your target return than you do going into something that's guaranteed to give you 1.5%.
Yeah, I think it's the thought process that I always like when we talk is, and you see it in your book as well, is getting people to just it's a quantitative, it's a systematic, it's a logical, rational, driven way of analyzing the world, the markets, as opposed to sitting back and just tightening up your underwear and feeling like something bad's going to happen.
Right. I mean, you're one of my early brokers I had was a Merrill Lynch broker in the early 1980s, and I had a month where I lost money, and her comment to me was, "Well, you're a trader. You lost money. That's what they do." And I started realizing, you can't make money every month. I mean, it's just, there's something wrong with that scenario, most likely. I remember an early comment, it was in a book on J. David Dominelli, one of the early Ponzi schemes in the 1980s. And one of the industry guys, was still around, Frank Pusateri, was quoted in the book when they showed him J. David's track record. What do you think? He said, "No losing months, it's fake."
Well, when I saw Madoff's track record, it was clearly, I mean, you didn't have to be a rocket scientist to see this. I think there was, in like a 10-year period, if you looked at all the months, there was like 2 negative months on Madoff's track record.
Right.
By the way, Frank Pusateri, I'm going to get on the show. By the way, we've exchanged some emails, so I know he's a wealth of insights going back over time too. So,
he's a character too. He'll have some good stories.
So let me jump into, and we're going to talk more about some career elements, because I think your career is divided up into several different levels or layers, quadrants.
Sure.
But I want to jump into something that I know is near and dear to you, which is the phrase return driver. And why don't you just define that for folks initially? I know we talked a little bit about it the first time we talked, but it's a very important concept for people to be thinking about, a way to tie this all together.
Right. Okay. So a return driver is really just the basic element, the basic characteristic that provides a valid reason for producing an inherent return in a trading strategy. So if you look at trading, it starts out with a return driver, and I'll give some examples. A return driver, you combine markets that are relevant to be used with that return driver to make it into a trading strategy. And then the way we trade is you combine multiple trading strategies to create a diversified portfolio of strategies and markets. So an example, with trend following, for example, you've got the psychological input, and I look at it, and I've always considered, for at least after my first couple of years trading, that the return drivers to trend following are the fact that, first of all, not everybody digest information at the same time, and even when you have information being disseminated to everybody simultaneously, you still get different reactions. You have people that are already preconceived to be, say, bullish on a market. They get data that supports that. They start buying it. The market starts moving. Ultimately, they reinforce that behavior. They think they're right because the market's doing what they think it's going to do, and they might buy more. They get other people on board with that maybe were on the sidelines, and you get these trends to perpetuate. So ultimately, you have the guys that have been bucking that trend, that have been short that market or negative on it, who capitulate, and you get into one of your parabolic, rallies to the top. So trend following is based on that psychological return driver that people will continue to do what they've been rewarded for doing, and that perpetuates trends. Another example of a return driver that I use in the book, I give a specific trading strategy there for trading stock index futures, or ETFs, based on money flows in and out of stock U.S. equity ETFs. So both the leveraged and the unleveraged, the inverse and the regular. And if you see a lot of money flowing in to the leveraged long ETFs, at some point, that money flow is indicating that you want to take a contrarian trade and you want to be short those markets. So it's a contrarian indicator that's based on emotion, based on human sentiment, and the fact that people tend to be wrong at the turning points. In fact, they create those turning points. And the strategy, it's very basic, looking at the numbers and the money flows, and most of the time it's out of the market, but occasionally it takes a short position or a long position for a short period of time based on that extreme in market sentiment. The return driver is that market sentiment. Now, there's different ways to look at it. That's one way we're measuring the money flows in and out of markets. You can also do it, and we have another strategy that we trade, and you can also do it looking at actual surveys, investor surveys, how many are bullish, bearish, percentages, and look for extremes that way as well. It's the same concept, little different the way it's being employed, same basic return driver, just using a different variable to define that, the extremes on it. But you have to have a sound return driver. You have to understand what the basis for the performance of any strategy is. Otherwise, you're just data mining.
Well, let me throw this out, because I know if someone hears this and they're not familiar with what you're describing, their first thought might be, well, he's just discussing some form of market timing, getting in or getting out, and you're up against decades and billions spent by the marketing machine out of Fidelity and the likes of Vanguard, that this whole concept of trying to do what you just described is a no-no, because if you just sit through it all, you'll do better in the long run. Why don't you discuss the idea of market timing and some of the naysayers out there?
Sure. So I cover market timing in the book, and one of the comments I make is everybody's a market timer. If you look at it and say, okay, they say, well, I'm not. I'm in an S&P index fund. Well, first of all, how did you decide to be in that? Why are you in that and not a Brazilian fund? Why are you in that and not allocated more into a European fund? They made the decision that was the better place for them to be than in Brazil or being in Europe. I ask them, why aren't you're not long uranium? Why aren't you long uranium? Well, I don't look at uranium. Well, that's a decision you made to be flat in that market. So if you look at it in the broad sense, there's thousands of positions people could take in any given day, and they've narrowed it to a few, and they've made the decision to be in those few, and they've timed the market by being long that and not something else. And at some point, they're going to have to make another timing decision when they get out of part of that. And my whole point is, why make that be dependent on when you need the money? Why not base it on something rational of when you should be in a market or out of a market? And the question that kind of comes up is, or I guess decision is, or comment maybe, is that people make is that, well, I'm in the U.S. stock market because that provides me with an intrinsic return, which is the very first myth I address in my book. And it's really the way I introduce return drivers as well, is if you look at the U.S. stock market, there's no magic. It doesn't just return money to people and go up. It's based on two primary return drivers. One is the earnings of the companies that make up the index, and the second is the multiplier, the PE ratio, essentially, that people are willing to assign to those earnings. And that explains 95% of the rolling 10-year price action of the S&P index. And what's even more kind of amazing to me when I did the numbers on it is that in periods of less than 20 years, the dominant return driver for stock prices is the PE ratio, the enthusiasm people have for owning or not owning stocks. That has nothing to do with corporate earnings. And so people are sitting there picking stocks or going into something because they think that the company is going to grow faster or whatever it is. No, it's Apple stock goes up primarily because more people want to buy Apple stock, and not because the earnings are going up. And the stock market overall over the last century has gone up because corporate earnings have consistently increased over a long period of time. And that's fine. But if those conditions aren't going to hold, then the next 100 years aren't going to be the same as the last 100 years. You can't just extrapolate it out and call it intrinsic return or call it risk premium. It's based on a sound return driver. And once you understand that, you can develop trading strategies to trade around that.
I think it probably one of the greatest things to kind of fall into our lap in the last decade would be the behavior of the Dow and the S&P, because I think finally when people see an over a decade long period of extreme volatility, 50% drops, overall flat, I think that opens them up, that makes their palate welcome to the idea of perhaps some of the very issues you're addressing.
Absolutely. And during that period, you had profit growth. So you can't sit there and say, okay, well, we had recessions and that's why it was held back. No. The reason stocks didn't go up in price in the aggregate and the composites over the last decade is because people wanted to pay less for each dollar of earnings. Earnings did increase, but where we had a 20 plus PE ratio on a 10-year, sort of average, in the late 90s, early 2000s, you dropped to half of that, by the end of 08, 09.
Let me, Mike, I want to just address one thing real quick, and then I want to jump into some of where you're at today with this relaunching of your systematic multi-strategy at Brandywine. But the way your book is constructed, for people out there that have not yet seen it, Jackass Investing is constructed with many myths that Mike has put out there. And I think, given all the things that you've been talking about, you could have some naysayers out there saying, well, this guy, Dever, he's been around, he's educated in the business, he's made some money, he's talking about some other guys that have been very successful, these are all big names, this just isn't for me. And I'm looking at myth number 15, and it says the largest investors hold all the cards. And I'm assuming that's a myth.
That's correct. Yeah, everything in there is a myth, and the people think that, and all these myths are based on some sort of observation out there. And in the 2008 financial crisis, and a couple years after that, people started feeling like the game was rigged against them. That the big guys controlled the market, they pushed it around, they were able to profit from volatility and the different things that were hurting the small investor. And I just want to lay that myth to rest, because the fact is that the big guys, they have a hard time moving their billions of dollars around. There are specific trading strategies that they can't employ because they're just too big to employ those. The small guys can take advantage of those strategies. I put one of them in the chapter specifically, and it talks about if you look back over time, you've had a lot of studies showing that small cap stocks over time outperform large cap stocks. But the reality is the research kind of started normalizing for different variables, is that it was really the less liquid stocks outperform the more liquid stocks, and a lot of the smaller cap stocks tend to be very illiquid, not a lot of trading relative to their market capitalization. And I show a graph in the book that shows the difference between the annual returns and the liquidity of stocks. And, for example, the most liquid small cap stock has an annualized return, I think it was somewhere around 5 or 6%. The least liquid smallest cap stocks have annualized returns that are closer to 20%. Those are stocks that the big investors can't touch. They're ones where a small investor can put $10,000, $20,000 into, but a larger investor, they can't put the $100 million they need to put into that stock. Now, the whole company's capitalization might only be $200 million. So the fact is that there's a lot of strategies, shorter-term trading strategies, for example. These illiquid stocks is the one example in the book, that give the edge to the small investor, not to the large investor.
But I said we were going to jump right into your current multi-strategy trading and what's going on right now with your new launch in 2011. But one thing I wanted to address that I forgot to bring up was, during your trading in the 90s, you were one of the first outside investors in a firm that a lot of people, I know a lot of Europeans have heard of, but probably a lot of Americans have not heard of, a firm called TransTrend. And I've actually, in other professionals like yourself, have heard the utmost respect for this particular trend follower in terms of their performance. And over the years, it's just a huge amount of respect. And they've had tremendous growth in assets and like I said, great performance. Why don't you speak a little bit to your experience with that particular firm and maybe anything you might have learned from your involvement with TransTrend?
Sure. So I had published to kind of go through my history a little bit again. In the 80s, I started putting some funds together using outside managers. So I had selected Paul Tudor Jones early on, and then John Henry's. And then in the late 80s, I made the decision, around 87, I made the decision that I wanted to shift my trading from primarily discretionary kind of trading that was system supported. So I started out developing a lot of systems early on with my first fund, but ultimately when it got down to trading, I didn't have the full faith in those systems. And it was sort of warranted. They weren't properly developed and back tested, and I didn't really fully understand the concept of return drivers then. So I still had a large element of discretion that would sort of underpin my trading through the 80s. And in 1987, I started a research project. We had various institutions involved in it, the Chicago Board of Trade being one of them, and different universities that were doing research projects, and we pulled them in to develop a fully automated multi-strategy trading model. And we developed a lot of innovative concepts at that time, but with allocation across markets and strategies, that we still hold today, which were very different than what people were doing then. But I published an early research paper in, maybe it was 1990, prior to the start of our trading, maybe it was 89, that talked about a lot of the things we were doing. And I got a call from the founder of TransTrend, saying, I read this, I think we share a lot of philosophy. I've been trading for, it was a commodities firm, I believe, in Rotterdam, and it'd be great to get together. And it so happened I was visiting a friend in Amsterdam a month or two after that, and I set up a time to come over to his office and meet with him. So we met, we hit it off great. I mean, we had, such shared philosophy in what he saw that he wanted to do and what we were, setting up to do as well. And shortly after that, he called and said, I'm going to be leaving my firm. I set up my own CTA. I just thought I'd let you know. And I said, that's great. What are your plans? He told me they were going to put a little fund together. And I said, okay, I'd like to seed that fund for you. And that was 1992. He got he left his firm, he got his fund launched, and we made the first investment into his fund from one of my other funds where I had outside managers that I had selected. And I haven't used a lot of outside managers over the years. I mean, Nate Cantor, Paul Tudor Jones, John Henry, another turtle, Jeff Gordon, and TransTrend. So they were one of the few that kind of met my criteria and shared a philosophy that I felt was a good long-term philosophy for making money.
Well, most of these guys have, I've talked to Jeff, and Jeff's a very interesting guy. I know, I'm not speaking out of turn or anything. I know Jeff has not made billions, but the other guys I think have all made billions.
Yeah, absolutely. They absolutely have. And I'll tell you, to hit Jeff for a second, he could have. And the only thing that I see with Jeff, and I don't think he would disagree, is his risk aversion. When we set up with Jeff, he got to where he would trade less and less and less in the account until we got to a point where we had no positions on. And I said, Jeff, this isn't right. This isn't your model. He says, I know, but I don't want to take any risk. I don't want to lose money. And I said, look, I don't care if you lose money. I welcome it, because I know if you're losing, you're going to make some. I said, so why don't you do this? Why don't you create two programs? You can have your conservative program and your aggressive program. And I'm going to go in the aggressive program. And I want you to take every signal that comes out of your model, and I want you to trade it in that program. And I know there's going to be losing days and losing months, and we're going to have losing years. But over time, it's going to make money for me. And he did that for about 6 months before he couldn't do that either. This is almost 20 years ago, so it's a long time. I'm sure he's changed significantly since that time, but he was just so risk averse that it impaired his trading at that time. And I bring this up because we just talked about it a few minutes back with investors today, and there's so many investors out there today that are risk averse to the point of creating risk in their portfolios, putting money in a 10-year bond at 1.5%, absolutely creating a guaranteed loss in their portfolio relative to what they need to earn. But they feel safer doing that. They don't even realize the level of risk that they're taking.
It's funny, and I don't want to belabor it too much, but because I want to jump into your current right now. But I think that you raised an interesting point with Jeff, because having written the book, The Complete Turtle Trader, I see people that there's sometimes this misunderstanding about the turtle story, and there's this idea that everybody was this huge winner, and it's not true. And I think the folks that have ended up being the winners, the folks that have had the duration of a career, the Liz Chevals, the Paul Rabers, the Tom Shanks, the Jerry Parkers, I think they are practicing the thought process, the principles that you're describing. They have the way of looking at the world, the way that you're describing throughout this interview. Whereas some folks, we're not saying it's necessarily easy, but maybe they overthink it, or they think there's a way around it, or they just forget there's a meat and potatoes, big picture principles that you have to stick to, not unlike what you're talking about with John Henry. And that maybe some people just didn't either want to do it, couldn't do it, or whatever, but it doesn't invalidate the big picture idea of this being a working mentality, a working philosophy, a working way to trade the markets.
Right. No, absolutely. It's a philosophy that isn't suited for implementation by every person. That's the problem. And some people can't take the day-to-day fluctuations that you get from trading, and they're looking for something that's smoother. What they're losing sight of is the goal isn't today or tomorrow. It's, hey, I'm retiring in 20 years, or I've got to pay for college education, and they've got longer-term plans. And instead of focusing on what do I need to do to achieve that, they're looking at the short term and measuring their risk by how much they could actually deviate from their long-term need in the short term. And those are actually what create the opportunities in the market. It's those people, in my mind, that create the dislocations. It's small investors who are complaining about volatility. Embrace that. If people are really irrationally pushing markets out of whack with their true value, well, they're providing you a free opportunity. Take advantage of that. Don't complain about that. But not every person is meant to be a trader.
And I have to reflect though too, because I'm not trying to talk out of place. But Jeff was a fantastic interview and was very self-reflective about his experiences and everything. And I would have to go back through, but I know there were critical points in my book where I frankly would have not been able to put that complete story together if Jeff had not been so frank about what he had seen and what he had learned. So I was most appreciative of his candor.
Oh yeah, he's a great guy. He's a great guy, totally honest, and if he says something, he means it, and it's the truth. He's not going to just say something.
So where is Mike Dever today? I know you've relaunched this fund, your fund, last year. So why don't you kind of bring people up to speed with all these different experiences you've had over a 3-decade period, and perhaps even why you decided, because I know for a long stretch there, you've been a technology entrepreneur, and I'm sure we could go into that for a long period of time too, but I think you probably would right now would rather kind of bring people up to speed about why you did this relaunch and what's it all about, and maybe just as we kind of wrap up here at the end, let people know what's going on.
Sure. Okay, so through the 80s, we traded that model that I described that we developed in the 90s, our Brandywine benchmark program, which was developed out of the research project in the late 80s. We traded that from 1991 to 1998. Multi-strategy, broadly diversified managed futures program. I also rolled out a market neutral equity product, a market timing product, mutual fund arbitrage, a variety of different trading programs through the 90s. But one of the things I did was I launched a company called Spree.com, which by mid-98 was the 7th most trafficked e-commerce company in the world. And it started consuming a lot of my time. We started getting acquisition interest from GeoCities, Lycos, different companies out there. And unfortunately, Brandywine got, I guess, a little bit of the neglect during that period. I brought somebody in to run it, but they didn't share, and they hadn't been with me from the start, so they didn't share my sort of corporate philosophy or research philosophy, that we had. And ultimately, I did get back out of Spree.com at the end of 99 and early 2000. But at that time, Brandywine was really a mutual fund arbitrage business, not a managed futures firm anymore. We ran that for a few years, but I started getting more involved in the 2000s with technology businesses. And we founded one in 2000, which we sold in 2007, called Internet Seer. And after selling that, I made the decision to get back into trading again as my primary full-time business. So we started updating the trading strategies that we had developed in the 80s and in the 90s. Put the systems back together and the infrastructure, back tested, got everything up and running. I went out in 2010 for seed funding to bring in a single early outside investor to have a non-proprietary trading record in a new fund. That money came in. We brought in $10 million in July of 2011 and started trading that. So what we're trading today has as its base the research and the trading we did in the 1980s and 1990s. About two-thirds of the trading strategies, and we have a few dozen strategies in the portfolio now, that make up our trading were from that era. All we did was update the testing on them. They continue to perform as we originally tested them to perform on 1970s and walk-forward blind simulation 1980s data, and as they actually performed in 1990s data. And they continued to perform well through the 2000s in the forward test. So those are in the portfolio. And then we've added about another third of the strategies that are in the portfolio today were more recently developed in this time period, 07 through 2010. And tend to be more fundamentally based. They tend to be our arbitrage type strategies, or fundamental, or intermarket relationships, and not just pure technical type strategies. So we end up with a portfolio today that's probably the latest number I got is in the low 20% trend following, which we view as a great solid alpha hedge in a way. We expect performance out of that, alpha generation, but it serves as a hedge against our other strategies maybe being on the wrong side of a trend. That fundamentally market may be indicated that it wants to be long in the market, the trend is down. So that's a natural hedge where we're offsetting those risks, but over time, each of those strategies individually is intended to produce profits in the portfolio.
You know what I like about what you just said, Mike, is that one of the things, of many things you've said today that are great, is that the idea that with pride, you say that here you are in 2012 implementing strategies that were developed upwards of 2 decades ago. And you're saying that with pride, okay? Whereas you have stock jockeys sitting out there, eating Adderall and all kinds of amphetamine type products, and they're going a mile a minute, and they're glued into a zillion and one different screens. They got all kinds of things buzzing, and their first thought when they hear Mike Devers say that guy, he doesn't know what he's talking about. He can't use a system from 20 years ago. That's worthless. He needs to have something rough and tumble today. Da da da. And what they miss is the very, very important point that you're saying, which is the Zen aspect, which is the people aspect, which is the human nature aspect. So when Mike Devers says that he is using a trading system, one of them that has got 20 years of development behind it, he's not telling you that he's using something old. He's not telling you that he's using something dated. He's telling you that he properly understands human nature. And more than that, he understands that human nature doesn't change, and that human nature is best manifested in market movement. And if people think that human beings have changed since the late 70s or early 80s or early 90s, and that somehow or another people are different today, Mike, what would you say?
They're wrong. I mean, what changes, potentially are the ways you can measure that human nature. For example, I talked about that one strategy that's looking at leveraged ETFs and inverse ETFs and money flows in and out of those. That's a strategy that didn't exist 20 years ago. Those ETFs didn't exist. But the concept of market sentiment and being a contrarian indicator is as valid today as it was 20 years ago. We just now have some new methods for measuring that, that we can turn into a trading strategy to further diversify our portfolio. But I think what it gets down to is when we developed these in the late 80s and into the 90s, is without knowing it, I based them on sound return drivers. I didn't really understand the return driver concepts as well then as I do now, or even have maybe voiced it, and defined it. But we clearly developed strategies that were based on sound return drivers that remain valid today.
Well, and I think that's the best way to sum it up, Mike. I want everyone to pick up Mike's book, Jackass Investing by Michael Dever. Don't do it. Profit from it. If you've not read it, if you don't have it, then you've got some kind of deficiency that you should work on that I can't really solve. Mike can't solve it. Take a look. Mike, if people want to connect more with you and they want to perhaps maybe they want to check out your firm, ask a question, connect with you in some way, what's the best way for people to reach you?
Best way is go to brandywine.com, www.brandywine.com. We have contact information there, information on the firm, and feel free, give us a call, send me an email, and I'm happy to talk.
Mike, sounds great. And hopefully we can talk again this year. These are always, and by the way, you gave some really great nuggets today. And I think my favorite nugget was, and the whole notion of John Henry doing so successful with his blackjack informational book. That was a really interesting note. Because you know what? I tried to find that dang thing 15 years ago, and I looked everywhere, and I couldn't find it anywhere, and I've still not seen it. So if you have a copy, I have to see a copy.
You know what? I don't, and that's why I say I think it was more of a pamphlet than an actual book, self-published, multi-page pamphlet that he sold.
Yeah. It's a great story.
He did great with it, and he turned it into the Red Sox now.
There you go.
Well, thanks, Michael. I really appreciate it and having the time.
Okay, take care, man. See you. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.